Hello, this presentation is about a merger of Company A and Company B. The investment group I was working for was had a vested interest in Company A. So what this presentation is about, the different options of mergers that can be done when Company A decided to merge with Company B. Now, Company A was the more healthy company at the time, and that's what we're going to look at in this presentation. So basically, Company A announced that it was going to merge with Company B in an all-stock transaction of $2 billion. The trends in the two stocks, Company A is on the top and Company B is at the bottom. So basically, because they're both same type of services, they both were trending almost the same the whole time. And this is a 3-month time period that we were looking at before and after they do their announcements of the merger. Beforehand, historical, it has also gone the same. Both Company A and Company B have been trending the same as this. Now, that dip at the beginning happened because it fell. Company B was falling when it announced that it needed to merge or be bought out or something because it's financially becoming difficult to handle. And so then it spiked back up when Company A said that it was going to merge with Company B. Moving to the terms of the agreement, basically Company A, the shareholders of Company A would receive 0.18 of a share of Company A stock in exchange for each share of Company B, because this is an all-stock transaction. Now, because of that, there's an arbitrage opportunity. There are many scenarios for arbitrage opportunities in this transaction. Well, the top two is what I'm going to talk about. The first one is to sell short Company A stocks. So they're going to sell short Company A stocks and then buy Company B. This option is more of a riskless to capture the spread, and assuming that Company A stock will still perform at the current level. So basically, better explained on a graphical standpoint, Company A was trading at 39.41 per share and Company B at 5.90. The 0.18 value to Company B is the 18% discount, which results in the 7.18 merger amount. This would be at least 21% appreciation if the stock of Company A would stay close to that 39.41, as mentioned a second ago. Now, what I want you to point out, remember, is this 21%, that's the arbitrage profit, as I was saying, of the many different arbitrage opportunities that exist in this transaction. Another opportunity, or the second opportunity, would be to use options to sell call options and buy put options. Or Company B's call options can be purchased and puts sold instead of buying the shares themselves, as mentioned a second ago. For long-term investors, they would buy Company B, convert it to Company A's stock price, and then let it grow over a long-term basis. So they would gain more money to increase their portfolios. Now, here's the two options sort of explained a little more graphically. Over on that far right is the discount to acquisition price, and right here is the cash flow from short of Company A and to long of Company B. So basically, the graph on the left is discounted Company B measured against the actual share price of Company A. Graph on the right is more of the short selling and buying of the $5.49 shares of Company B. Here, Company B should then generate enough shares to offset the short position that it is in, or is going to be in. So those are sort of the explanation of the two merger options themselves. Now, in order to keep going and maintain that company A's health, we want to see if that stock is an actual price of 39.41. And we also want to see if the company A's health to maintain this stock in the future will be consistently growing. So what we did is we looked at the past historical 5 years of company A compared it with S&P 500. So the two numbers I want to point out is the beta is 0.83 of company A, and the undiversifiable risk is 2.67 compared to the S&P 500 of 3.18. Also, too, the average return. If you look at that the last 5 years, the 3.1% is the average return versus the S&P 500, which is negative 0.02 because of the stock price fall in 2008. So in the long run, 5 years isn't really a good transition to an S&P 500 because that's too short. You don't want to compare something with a negative return. But certain numbers we did, but then we also went back 20 years. Then we did a regression. So we did a regression analysis basically using to find the intercept, which ended up being 0.00325, and the return of standard deviation of beta is 0.39, as I mentioned a second ago, to get an R squared of 0.533. We were doing this to get an SML line on a graph, which is right here. See, as you can tell, this is the resulting of where the stock price should be, or 39.41 should be. These are all the prices over a 5-year period, with the S&P 500 being this line, and this is our values. When they intersect, this is where they all rely on. So that's the good regression based off of the R squared of 0.533, as you can see up here. So then we also did a DuPont analysis. The main thing on the DuPont analysis I want to point out is the 91% of 2008 gain compared to the 23. See, it was growing, then it went really high, the ROE, and it still maintained high in 09. And also, too, the financial leverage. As you can see, the financial leverage was up at 8 in 2008. So it was maintaining, as you can see here, 3, 4, and then 8, which was maintaining. It still had some leverage. Now, company A's versus the industry, we also wanted to compare to see what the whole industry itself was doing. And so you can see here, 11 is the profit margin to the 9.2 of the industry, which is better. And then the ROE is also really high, as mentioned earlier. It's also really high, 20% higher. So that's really good. So those are two good signs that the company A is still in good health. Now, we also wanted to do a price-book ratio because we were trying to compare to the actual competitors themselves. So in doing this, we saw that only competitor Z down here had 8s and 9s compared to our final version of 7s and 8s. So basically, we did a balance sheet and put all the numbers together, and that's how then we got our price-to-book ratio, and they compared top. Only one of the company was as good as us. And then we did a sales forecast because we needed to see what our future sales are going to be of the company. So basically, this is showing right here the next year's sales, following year's sales of the forecasted compared to all the other competitors. So what we did is we got competitors of all the companies, and we found an industry growth of 7.14. We did a regression on this, getting a 0.428 and a 44.58 to multiply that by the total sales to end up getting the projected of 102,000. And what I'm showing you on this is the actual regression. The actual regression numbers that I just pointed is the 0.1428 and the 44458, along with the R square is also important, 881, which is decent for what we're doing. Now, here's the sales forecast And here's that 1428 and then the 4458. So that 4458 is the intercept. And we also want to look at the margins. As you can see here, the margins for all of the products, all the gross margin, the pre-tax margin, and the net profit margin are all higher. You know, everything from 9 to 11 to 12 to 15, 37, 42, so that's a really good sign. And then we did an EPS projection. So we wanted to do a historical EPS, and we wanted to do a 2010 EPS estimate. So basically, we found out the historical is 11.79, with the 10.78 being the next year's, the following years, which is a good sign because it's staying on still. So the two methods end up working out pretty well. We also wanted to find finally the required return, so we can see if the actual stock price is going to lie on the line of the regression line that we talked about in the beginning. So required return on a 20-year basis ended up being 9.50. The beta you used was the 89 based off of that data for 20 years instead of using the 5-year data in the scenario because of the negative value. So this was a positive value, which is the 9.50 required return, which ended up being putting the numbers together of the formula ends up landing right there on that line. So we did 2 or 3 different times, and they all end up lying right there on the line. So it ends up, we found out in conclusion that the stock was relative to what the data is. So it ended up saying, and now the numbers showed and pushed to that this was a good company, and we can maintain the or keep our money in going along with the mergers. Thank you for this for your attention for this presentation.